Welcome back to the deep dive. Today, we're going to do something a little different. Usually, we look at the flashy stuff, the companies grabbing all the headlines, the consumer brands you see everywhere, the tech giants that live on your phone.
Right, the stuff that's front and center.
Exactly. But today, we are pulling back the curtain on a company that represents the invisible architecture of your entire financial life.
It really is the invisible layer. And I think invisible is the perfect word because the best infrastructure, well, it's the kind you never even notice. Not until it breaks, anyway.
That's so true. I was reading through these notes, and I had this slightly terrifying realization. You can use Robinhood, you can use E-Trade, you can use Schwab. Maybe you have a 401k with Fidelity.
All the big names?
You think those are the companies managing your money. You think that's where the buck stops. But effectively, if you live in the modern economy, your money, your investments, they're all traveling through the pipes of one specific company that you have probably never heard of.
Or if you have heard of it, you probably just dismissed it as, boring.
Totally boring. And that's the thing. Usually when we start talking about financial infrastructure or back office plumbing, you can almost hear people's eyes glaze over.
Oh, yeah. They tune out immediately. They start thinking of dusty filing cabinets, regulatory filings, maybe people in green visors stamping paper in some basement somewhere.
It's boring stuff. But the company we are looking at today has effectively monopolized the boring stuff to the point where they are now arguably the gatekeepers of the entire U.S. financial system.
It's not an exaggeration.
We're talking about Broadridge Financial Solutions, ticker symbol BR. And the headline here isn't boring back-office utility. The headline is, what happens when the company that delivers your mail decides to build the blockchain operating system for Wall Street?
It is a massive transformation story. I mean, we are looking at a business that started as a spinoff from ADP, the payroll people, way back in 2007.
Yeah.
For years, they were viewed as just this legacy paper pusher, a corporate mailman, basically. But as we sit here in February 2026, that whole narrative has shifted. It's completely changed. They are transitioning from a proxy mailman into a real fintech powerhouse.
I love the analogy we found in the research that Broadridge is the Amazon Web Services of finance.
It's the perfect analogy.
It really is.
Yeah.
You watch Netflix, you think you're watching Netflix, but you're actually using AWS servers.
Yeah.
You trade a stock, you think you're using a cool app, but the engine room, the actual plumbing that settles that trade, that's Broadridge.
And it's not an exaggeration at all. I mean, think about the scale here. If Amazon Web Services goes down, what happens? Half the internet stops working.
Yeah, no Netflix, no Slack, just chaos.
Total chaos. Okay, now apply that to this. If Broadridge were to shut down tomorrow, the U.S. markets would effectively grind to a halt. They process over $15 trillion in daily trade volume.
15 trillion?
Yeah.
With a T.
With a T daily. They serve 95% of the largest U.S. companies. They are the definition of too big to fail, but in a way that regulators and the public, they rarely talk about it because they operate in the shadows.
$15 trillion a day. That number is just, it's hard to even wrap your head around. So our mission today is to unpack this beast. We're going to look at their massive toll road business model, this incredible competitive moat they've built, which I think is one of the widest we've ever seen, and the very specific financial situation they're in right now after their Q1 2026 earnings.
And we have to talk about the 3D strategy. That is the absolute core of their future.
Democratization, digitization, and decentralization. Those are the three big megatrends they are betting the farm on. And we really need to figure out, is this just a sleepy utility stock that pays a nice dividend?
Or is this actually a misunderstood tech growth play that's just been hiding in plain sight this whole time?
Let's find out.
Let's dive in.
Okay, let's unpack the business model first, because I think this is where the aha moment happens for most people. Broadridge is basically two massive businesses glued together, right?
Correct. You have the Investor Communication Solutions, or ICS, and then you have Global Technology and Operations, GTO for short.
Let's start with ICS. That's the big one, the original business. This accounts for, what, about 74% of their revenue?
Give or take, yes. That's the lion's share. And this is what I call the mailman business. But to really understand why it's so profitable and why it's basically a monopoly, you have to understand this weird quirk of the American financial system called street name.
Street name. That sounds like a rapper's alias. Yeah, hold my stocks in street name. Break that down for us. Why does this one detail matter so much?
It matters because of how ownership fundamentally works in the market today. Back in the day, I'm talking 50, 60 years ago, if you bought a share of, say, General Motors, you got a physical piece of paper. a stock certificate.
Oh, yeah, with a fancy filigree and your name printed on it?
Exactly. You got that certificate, it had your name on it, you put it in a safe, it was tangible, you held it.
Right. The classic movie scene where they open the safe deposit box and
Yeah.
there's just stacks of bonds and certificates inside.
That's the one. But trading physical paper is incredibly slow and inefficient. As the market sped up in the 70s and 80s, they couldn't wait for FedEx or, bike messengers to move all these certificates around Wall Street. The volume was just getting too high. They had what they called the paperwork crisis.
The system was breaking under its own weight.
It literally was. So the system changed. They immobilized the paper. Now, when you buy a share of Apple or Microsoft through your brokerage app, you don't actually hold the stock certificate. The bank or the broker like Fidelity or Schwab holds it on your behalf. That's called holding it in street name.
So wait, Apple doesn't know I exist as a shareholder.
Precisely. That's the key. Apple knows that Charles Schwab or Fidelity or Robinhood owns a giant block of shares. Let's say it's 1 million shares. But they have no idea that you, the individual listener, own 10 of those shares. You are completely invisible to the company you invested in.
Okay, I think I follow. But here's the catch, right? Legally, Apple has to talk to me. They have to send me stuff.
Correct. And this is the crucial part. This is the whole ballgame. Under SEC rules, Apple is required, it is mandated by federal law, to send you their annual report, their proxy statement, and give you a chance to vote on their board of directors.
So there's this massive disconnect. The company needs to mail me stuff because the law says they have to, but they don't know who I am or where I live because the bank is effectively hiding my identity.
Enter Broadridge. Broadridge sits right in the middle of that disconnect. They are the bridge. They have the master database that connects the banks to the companies. When Apple wants to hold a vote, they send the materials to Broadridge.
And Broadridge sorts it all out.
They sort it all out. Broadridge looks at the bank records, which they have exclusive access to because they've integrated their systems with all the banks. They figure out who actually owns the shares. They send the emails or the physical mail to millions of people. They collect all the votes, they tabulate them, and then they hand the results back to Apple.
It really is the only bridge in town.
It effectively is. I mean, get this. They process over 7 billion of these communications every single year.
7 billion.
With a B.
7 billion. Imagine the logistics of that. 7 billion touch points. And the beauty of this model, from an investor's perspective, is the revenue mix. You have your recurring fees, which are super sticky just for managing the platform.
That's the base level.
That's the base. Then you have distribution revenue, which is the postage and printing. Now, that's high revenue, but it's very low margin, basically a pass-through cost. But then you have the really interesting part, event-driven revenue.
Which we saw absolutely explode in the recent Q1 numbers. A huge explosion. Event-driven revenue is when a company has a contested board election, or a hostile takeover, or a big mutual fund reorganization. When things get chaotic and messy in the boardroom, Broadridge gets paid.
So chaos is good for business.
Volatility in corporate governance is very, very good for their business. Think about it. If a company has a boring, quiet year, they send out one proxy statement. Simple.
One and done.
But if they are fighting off an activist investor who wants to fire the CEO and replace the board, they might send out 5 or 6 different communications. They're mailing fight letters, rebuttal letters, new proxy cards with different colored paper.
Oh, wow, yeah.
Broadridge charges for every single one of those touch points.
It's like charging for ammo in a war. You don't care who wins, you just sell the bullets to both sides.
That is a very apt, if slightly cynical way to look at it, but yes, that's the model.
Okay, so that's the mailman side. Highly regulated, legally mandated, and it thrives on complexity. Now, what about the other side, the GTO segment? Global technology and operations. You called this the infrastructure role.
Right, and this is the other 26% of revenue, but do not sleep on this segment. It is arguably the stickier, more strategic side of the business. This is the software that powers the entire trade lifecycle.
Okay, walk us through the life cycle of a trade. Because I think we all take this for granted. I hit buy on my phone, I see a little confetti animation, and I assume I own the stock. What is actually happening in the dark?
So much is happening. You hitting buy, that is just the start of the journey. That order has to be routed to an exchange. It has to be matched with the seller who's willing to sell at that price. Then it has to be confirmed, where both sides agree on the price and the quantity.
Okay, that's the execution part.
That's just the start. Then it has to be cleared. That's the process of checking that you actually have the money in your account and the seller actually has the stock to give you. And then finally, maybe a day later, it has to settle. That's the actual final movement of cash and ownership.
And all of that back-end messiness, that's where GTO comes in.
That entire back-end process, the record keeping, the clearing, the settlement, is powered by Broadridge's GTO platforms for a huge, huge chunk of Wall Street.
We're talking about $10 trillion cleared and settled daily. Is that right?
It's a massive, massive volume, and they've been expanding this aggressively. You might remember a couple of years back, they acquired Kyndryl's Securities Industry Services, or SIS.
I do remember that.
That acquisition has been a major growth driver for them, especially in Canada. It's helping them push deeper into the wealth management space. So they aren't just doing the deep institutional plumbing anymore. They are now powering the desktop tools that financial advisors use every day.
So if I'm a big bank, Broadridge is handling my customer emails, my proxy voting, and my back-end trade settlement. This leads us perfectly into the next section, the competitive moat. Because looking at all this, my immediate thought is, why doesn't someone else just do this? Or why don't the banks do it themselves?
That is the multi-billion-dollar question, isn't it? And the answer lies in what we call the regulatory toll road.
I love that phrase. It sounds expensive.
It is extremely expensive to build, which is exactly why no one else does it. I mean, think about it. Public companies must communicate with shareholders. It's not optional. It's federal law.
Right.
Because Broadridge has already integrated with every single major bank and broker-dealer, we're talking about over 1,000 bank clients, creating a competitor from scratch would mean you'd have to convince every single bank in America to rip out their old systems and install a new one to talk to your new platform.
It's a network effect on steroids.
It's the ultimate network effect. It's a monopoly dynamic. Broadridge serves 95% of the largest U.S. companies. It's not just that people like using them. They arguably have to use them because the regulatory compliance is just so complex and the network is so deeply established.
If you're a new fintech broker starting up, you just plug into Broadridge.
Of course. You don't try to build your own proxy system. It would be business suicide.
And then on the other side, the GTO, the settlement side, you have the issue of switching costs. We saw a great analogy in the research comparing switching your back office system to performing open heart surgery while running a marathon.
It's a terrifying prospect for a bank. I mean, imagine you're the CIO at a major bank. You're processing billions of dollars in trades every single day. Your systems are old, sure, maybe they're a bit clunky, but they work.
They work. Don't touch it.
Don't touch it. If you try to switch your settlement provider and something goes wrong just for 1 hour, you could lose millions of dollars, you could face massive regulatory fines, and you could destroy your bank's reputation.
So the risk of staying with the old reliable system is low, but the risk of switching is absolutely catastrophic.
Exactly. The risk of leaving Broadridge is so astronomically high that nobody in their right mind wants to do it. It's career suicide for a CTO to even suggest it unless it's absolutely fundamentally necessary.
Which would explain the client retention rate.
98%. In the SaaS world, the software as a service world, 98% revenue retention is the absolute holy grail. Companies would kill for that number.
And for Broadridge, it's just business as usual.
For Broadridge, it's just Tuesday. Once a bank is plugged into Broadridge's plumbing, they almost never leave.
So we have a near monopoly on one side and a critical, sticky utility on the other. That sounds like a money printing machine. Which brings us to the financial reality. We're looking at the Q1 fiscal year 2026 earnings that came out recently.
Yeah.
And the numbers were, honestly, they were startlingly good.
They were very strong, but we have to be really careful with them. There's a paradox hiding in these numbers.
Okay, let's hit the headlines first, then we can peel back the onion. Total revenue was $1.59 billion, up 12% year over year. Adjusted EPS, that's earnings per share, was $1.51, up 51%.
51%.
If I just saw that headline, I think this is the fastest growing tech stock on the market.
So we're back.
51% earnings growth for a boring utility. Something's up.
Right, and that's the trap. You have to look at why it went up 51%. The primary driver, the main reason, was that event-driven revenue we talked about earlier. It spiked 81% to $114 million in a single quarter.
An 81% jump.
Yeah.
That is massive. And the research says this was caused by just one specific event.
One specific massive event, a huge proxy contest at what they called a large mutual fund complex. We don't know exactly which one, but you can imagine a scenario where a giant fund family like a Vanguard or a Fidelity had a really contested board election.
So they had to mail and email millions and millions of ballots.
Millions, and Broadridge got paid for every single one.
So it's a windfall. It's like
Yeah.
a hurricane hitting a town, and the one store that sells plywood sells out of everything.
It is. It's a one-time surge. And the paradox is that this earnings beat is lumpy. It looks amazing right now in Q1 2026. But next year, in Q1 2027, unless there's another massive knockdown, drag-out fight at a huge mutual fund, those numbers are going to drop back down to normal.
It makes the year-over-year comparisons really difficult.
Very difficult. So as an investor, you have to mentally strip that out to see the real underlying growth. You can't count on a giant corporate brawl happening every single quarter.
But what's the real health of the business then, if we look past the lumpy stuff?
Exactly. If you strip out the drama of the proxy fight, you look at the recurring revenue. That's the true health metric. And recurring revenue was up a very strong 9%, 8% if you adjust for currency.
That's a solid, healthy growth rate for a mature company.
It is. It shows that the core business, the subscriptions, the platform contracts, is growing in the high single digits, which is fantastic.
And management raised their guidance, didn't they? They're now saying recurring revenue for the full year 2026 will be at the high end of their 5 to 7% target range.
Which is a really significant signal. In a macro environment that has been a bit wobbly for a lot of companies, for them to raise the floor on their recurring revenue guidance, that's a strong signal of confidence.
And the margins are getting better too.
Yes, look at the margins. Adjusted operating income margin expanded by 280 basis points. It's up to 15.8% now.
That margin expansion is key. It proves they're getting more efficient as a business. And I think that efficiency ties directly into the next part of our discussion, the whole 3D strategy. Because they aren't just sitting on this monopoly, they're actively trying to modernize it and make it more profitable.
This is the most exciting part of the Broadridge story. This is the future. They frame it around 3Ds: democratization, digitization, and decentralization.
Let's take them one by one. First, democratization. This is all about the rise of the retail investor, right?
It is. I mean, think about the last 5 years. We've had the meme stock era. We've seen the explosion of commission-free trading apps. Retail investors now make up 59% of U.S. households. That is a lot of new accounts.
And more accounts means more emails, more proxies, more transactions, basically more fees for Broadridge.
Exactly. Volume helps. But it's actually deeper than just more volume. It's about engagement. We are seeing the rise of a new trend called pass-through voting.
Right, voting choice. I saw this in the notes. Explain this, because usually I just buy an S&P 500 ETF and I pretty much forget about it. I don't think about voting.
So traditionally, if you own an S&P 500 ETF from, say, Vanguard or BlackRock, you don't actually own the Apple shares inside that fund. Vanguard owns them. So Vanguard's management gets to vote in the Apple board election. You, the end investor, have no say.
Right. I'm just along for the ride financially.
But there has been this massive regulatory and social push for voting choice. BlackRock and others are starting to say, hey, we will build the technology to let the individual investor decide how their tiny slice of the shares should be voted.
That sounds great for shareholder democracy, but it also sounds like a complete logistical nightmare.
It is a nightmare. Can you imagine BlackRock trying to collect unique voting preferences from 10 million individual ETF holders on 50 different stocks in their portfolio?
No way.
Who builds the technology to handle that insane level of complexity? Broadridge. Their voting choice solution is already being used by nearly 400 funds representing $2 trillion in assets. They are turning a massive governance headache into a brand new product.
That is amazing. Okay, so democratization drives volume and complexity. Now, the second D, digitization. This feels kind of obvious, moving from paper to digital, but the financial impact must be huge.
It's the primary margin driver for the whole company. We mentioned earlier that distribution revenue, the postage for physical mail, is basically zero margin. Broadridge charges the client for the stamp, but then they immediately pay the post office. They make no money on it.
Right, it's a pass-through.
But if they can convince that shareholder to get an email instead of a thick envelope,
The cost to deliver it drops to near zero, but the fee they charge the company doesn't drop all the way to zero.
exactly. They share some of the savings with the client, of course, but Broadridge keeps a much healthier chunk for themselves. As they digitize more of those 7 billion communications, their margins expand automatically.
And now they're layering AI on top of that.
Right. They have tools like OpsGPT to predict trade failures and automate some of those manual post-trade processes.
GPT. It seems like everyone has a GPT now. Is this actually useful, or is it just marketing speak?
No, in this case, it's highly functional. In the back office of a bank, an AI that can scan millions of transactions and say, hey, this $50 million trade is likely to fail settlement tomorrow because there's a mismatch in the data, that is incredibly valuable.
Yeah, it saves real money.
It saves a lot of real money. It moves the process from fixing problems after they happen to preventing problems before they start.
Okay, so democratization and digitization are the evolution of the current business, making it bigger and more efficient. But the third D, decentralization. This feels like the revolution. This is where we get into blockchain, crypto, tokenization. I think for a lot of people, when they hear legacy financial firm doing crypto, they just roll their eyes. They think it's a gimmick.
I was skeptical too at first, but Broadridge is doing something very specific and very smart here. They aren't launching a meme coin or an NFT project. They are using blockchain to rebuild the plumbing of the repo market.
Okay, stop right there. The repo market. We need to explain this because it's a $10 trillion market that almost nobody understands, but it basically runs the world. I like the analogy of it being the pawn shop of Wall Street.
That's a great way to put it. Repo is short for repurchase agreement. Here is the simple version. Big banks need cash overnight to meet their regulatory requirements. Other institutions, like money market funds, have a lot of cash just sitting around, and they want to earn a little bit of interest on it safely.
Right.
So Bank A will sell a U.S. Treasury bond to Bank B for cash, with a legally binding promise to buy it back, to repurchase it the very next day for slightly more money. The difference is the interest.
So it's basically a super short-term loan that's collateralized by a super safe asset. I give you my watch, you give me cash, I come back tomorrow, give you the cash plus a little extra, and I get my watch back.
Yes. It is the grease that keeps the wheels of global finance turning. Trillions of dollars move this way every single night. The problem is, historically, it has been surprisingly manual. We're talking phone calls, spreadsheets, a bunch of disparate systems. You have to move the cash, you have to move the bond, you have to verify it all. It's clunky, and it's prone to errors and trade fails.
And a trade fail in a $10 trillion market has to be expensive.
Very expensive. It ties up capital and creates risk. So Broadridge looked at this whole messy process and said, this is the perfect use case for blockchain. Not for speculation, but for a distributed ledger. A single, shared, unchangeable source of truth where both banks can see the collateral and the cash moving instantly and automatically.
This is their DLR, Platform Distributed Ledger Repo.
Right. And the growth here has been absolutely exponential. In the last 6 months alone, the daily volume on this platform tripled. They are now processing over $300 billion in daily repo volume on the blockchain.
$300 billion a day. Okay, that's not a science project or a pilot program anymore. That is real scale.
It's massive. And it's saving their clients millions of dollars by stopping those trade fails and reconciliation headaches. It proves that blockchain has a boring, utilitarian, but incredibly valuable future in finance that has nothing to do with whether Bitcoin goes up or down.
But here's where it gets really, really interesting for the future of the company. Broadridge isn't just building their own private blockchain for this. They've positioned themselves as a super validator on something called the Canton Network.
The Canton Network. This sounded like pure science fiction when I first read about it.
Me too. Break it down for us. What is the Canton Network?
So, most blockchains we know, like Ethereum or Bitcoin, are public. Anyone can see everything. Banks hate that.
Of course, they need privacy.
They can't have their competitors seeing all their trades and positions. The Canton Network is designed as a network of networks specifically for institutional finance. It allows different private blockchains run by different banks to connect and talk to each other in a secure way while maintaining the privacy of each transaction.
So it's like the internet for all these private banking blockchains.
That's a perfect way to describe it. And Broadridge is running a node, a super validator, that helps secure and validate transactions across this entire network. And they are getting paid for it.
They generated $4 million in recurring revenue in Q1 just for being a validator.
Just for running the servers and validating the network, that's pure high-margin tech revenue. And because of this role, they hold a big stash of Canton Coins.
Which led to that weird number in the earnings report, the $46 million gain.
Exactly. They had to record a $46 million unrealized gain because the book value of those Canton Coins went up. Now, The analyst in me has to put up a big warning sign here. This creates noise in the GAAP earnings.
Right.
It's accounting volatility. One quarter, it could be up 46 million. The next quarter, it could be down 20 million. It doesn't mean Broadridge sold the coins and made 46 million in cash. It's all paper gains for now.
But it shows they have serious skin in the game. And they aren't just sitting on these coins waiting for the price to go up. I saw they made a really interesting investment in a biotech company.
Theramun, yes. This was fascinating. Broadridge used their Canton Coins to buy an 8% stake in this company, Theramun. They didn't use cash. They used their crypto holdings.
Wait, hold on. They bought a stake in a biotech company using coins they earned from validating a private banking network.
Yes. The stated goal is to help Theramun build a digital asset treasury. It's a proof of concept. They are trying to show the world and other corporations that these digital assets can be used for real corporate finance, for M&A, for investment, for treasury management, not just for holding and speculating.
So to recap the 3D strategy here, they are riding the wave of more retail investors, they're using AI to get more efficient and boost margins, and they are literally building the blockchain railroad for the next century of finance.
That is the bull case in a nutshell. They are positioning themselves so that no matter how the market evolves, whether it's paper or digital, centralized or decentralized, they own the pipes.
But before we get too carried away with this futuristic vision, I want to ground this in a real-world example of just how powerful their current grip is. We have a case study about Wells Fargo that I found fascinating.
Oh, this is the perfect example of what we call infrastructure validation.
So the big fear with Broadridge, the bear case, has always been in housing. The idea that a giant bank like JP Morgan or Wells Fargo just gets tired of paying the fees and decides to build their own software and fire Broadridge.
Right. Why pay the toll if we can just build our own road? It's the logical threat. And Wells Fargo recently decided to internalize their proxy voting decision-making. Basically, instead of relying on external advisors to tell them how to vote their shares, they wanted to decide for themselves.
Which, on the surface, sounds like bad news for a service provider like Broadridge.
You would absolutely think so. It sounds like they're taking business away. But here's the twist. Wells Fargo built the strategy team in-house, the brain, but they actually expanded their use of Broadridge's platform to execute the operational work.
So they still needed the muscle.
They realized we want to control the high-level decisions, but we still need Broadridge for the actual plumbing, the execution.
So even when a massive client wants to take more control, they end up using Broadridge more, not less.
Exactly. It proves that the moat is deeper than just providing advice or strategy. It's about the hard, complex, unglamorous operational execution. The plumbing is so complex that even a bank with the vast resources of Wells Fargo looks at it and says, nope, we don't want to build that from scratch. It's not worth it.
It's an incredibly powerful signal. But of course, no company is invincible. We have to look at the other side of the coin. Section 7, the critical risks. What keeps Broadridge management up at night?
There are a few big ones. The first, and arguably the most dangerous, is what we call the golden goose threat. We talked about how the whole ICS business is built on a regulatory mandate, the fact that companies must mail proxy statements.
Right. The SEC requires it. That's the foundation of the whole business.
But regulations can change. What if we get a new, very deregulatory SEC chair? What if the SEC decides, you know what, it's 2026. We don't need to push millions of emails and letters anymore. Companies can just post their annual report on their website. If investors want to read it, they can go find it.
That's the notice and access model, right? Just put it on the web and walk away.
It is. If that requirement to actively push the communication to every single shareholder is removed or significantly weakened, Broadridge's volume collapses overnight. The ICS segment, 74% of their revenue would take a massive, massive hit.
Right.
Now, is that likely to happen completely? Probably not, because shareholder engagement is generally seen as a good thing. But it is a real stroke of the pen risk that hangs over the business.
That's terrifying. One rule change and the core business model fundamentally breaks.
It also puts a natural cap on their pricing power, too. They can't raise prices too aggressively, or the industry will band together and lobby the SEC to change the rules. They have to keep their prices just low enough that nobody complains too loudly.
Okay, what about the people running the company? I did notice some insiders selling in the notes.
We have to watch that. The CEO, Timothy Gokey, sold about $1.47 million in stock recently, and other executives sold some too. Now, to be fair, executives sell stock for all kinds of reasons: buying a house, paying taxes, simple diversification. You can't read too much into one sale.
But when you see a cluster of selling at the top,
It just makes you wonder if they think the stock has peaked or if they see some headwinds coming that we on the outside don't. It's not a panic signal, but it's a yellow flag you have to be aware of.
and then there's the debt, $3.3 billion.
It's a significant load. Their leverage ratio is around 1.76 times EBITDA. That's perfectly fine. It's investment grade, rated BBB plus EBITDA. It's not a crisis by any means. But in a variable rate environment, holding that much debt costs real money. Their interest expense was roughly $24 million in the quarter.
And that eats directly into profits.
It does. And if interest rates stay high or go higher, that debt gets more expensive to service over time. It's just a drag on earnings.
And finally, there's the risk we already touched on, the volatility from the Canton Coins.
Right. And this is more of an identity risk. Investors who buy Broadridge usually want a boring, stable, dividend-paying stock. They want to sleep well at night.
The opposite of a crypto play.
Exactly. If suddenly the quarterly earnings are swinging wildly up and down because of the fluctuating price of a Canton coin, that might spook their traditional conservative investor base. They might just say, you know what? I didn't sign up for this. I signed up for a utility, not a crypto venture fund.
That's a great point. It's an identity crisis. Are you a sleepy, reliable utility, or are you a cutting-edge, volatile crypto venture capitalist?
They are trying to be both. And that is a very, very difficult balancing act to pull off.
So we've looked at the monopoly, the amazing transformation story, and the real risks. Let's bring it all together. Final verdict. If I'm a listener trying to make sense of all this, where does Broadridge land?
I think the best way to describe Broadridge is as a defensive growth core holding.
Defensive growth. Unpack that for me.
It's defensive because of that 98% retention rate and the regulatory mandates. Even if the economy crashes, companies still have to hold shareholder meetings, people still have to settle trades. The floor under this business is very, very high. You can sleep well at night knowing Broadridge isn't going bankrupt.
Okay, so that's the portfolio protection part. And the growth.
The growth comes from that 3D strategy we just talked about. They're targeting 5 to 7% recurring revenue growth and 8 to 12% EPS growth over the long term. Plus, they are a dividend contender. They've raised their dividend for 19 consecutive years. That's a powerful combination.
So you buy it for the safety and the dividend, but you hold it for the potential upside of that whole tokenization play.
Exactly. Think of it as buying a very safe, high-quality bond that comes with a free call option on the future of blockchain finance. If all the blockchain stuff fails, you still own a great monopoly business. But if the blockchain stuff succeeds, like we're already seeing with the $300 billion in daily repo volume, this company could be much, much larger in 10 years.
I also saw a note in the Outlook about 23/5 trading. What's that about?
Yes, this is another big tailwind coming late in 2026. The markets are moving toward trading 23 hours a day, 5 days a week, basically continuous trading.
The market literally never sleeps.
And if the market never sleeps, the plumbing that supports it needs to be absolutely bulletproof, 24/7. Broadridge is one of the only firms with the global scale and the robust technology to support that kind of always-on trading environment. That is a massive tailwind for their GTO business.
It really does seem like every major trend in finance, whether it's retail trading or blockchain or around-the-clock markets, it all flows through them.
They are positioning themselves to be the operating system for the future of money. That's the ambition. They want to move from being the mailman to being the central nervous system of global finance.
So what does this all mean for us, for the listener? What's the big takeaway?
I think it's a great reminder to look at the picks and shovels of your own portfolio. Everyone loves the flashy tech stocks, the AI darlings, the new shiny thing. But sometimes the best investments are the ones that quietly and reliably collect a toll every time those other companies do business. Broadridge is the ultimate example of a company that looks boring on the surface, but is secretly indispensable.
It really is the hidden giant.
And here is a final provocative thought to leave you with. We talked about how they are successfully tokenizing the repo market. If Broadridge succeeds there, if they prove that their blockchain ledger is faster, cheaper, and safer than the current legacy system, what's to stop them from doing that for everything else? Will they eventually own the settlement layer for all assets?
Wow. Not just repos, but stocks, bonds, everything.
everything. Imagine a world where Broadridge isn't just serving the exchanges, but effectively becomes the settlement exchange for all digital assets. If that happens, they become more powerful than the New York Stock Exchange or the Nasdaq. They become the fundamental bedrock of the entire global economy.
From delivering paper proxy ballots to owning the global digital ledger, that is quite a journey, and one worth watching.
It certainly is.
That's a wrap for this deep dive into Broadridge Financial Solutions. As always, we encourage you to look at the plumbing of your own investments. What are the hidden tolls you're paying? And more importantly, who is collecting them? Thanks for listening, and we'll catch you on the next deep dive.